Hey everybody, Jeff over at MetaStock. Hope you're doing well. Can everybody hear me okay? Just type a yes or whatever in the chat box, and that way I can know that we're broadcasting and everything looks okay. Should also be able to see my screen.
I can't hear you at all. Yeah.
Really? Mark?
No, I can't hear you at all. It's crazy.
Yeah, I think you're jerking my chain a little bit.
I'm completely jerking your chain, of course.
All right. Well, there's our speaker. Let me go ahead and read the legal disclaimer. We'll get straight to it today. I hope you guys are doing well. It's a beautiful afternoon here in Salt Lake City. I think it's like 65 degrees outside. So, but stay with us. We're gonna have a great session today. So, today's demonstration is designed to instruct you on using MetaStock and the accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should be used by investors who are aware of the risk inherent in trading. MetaStock shall have no liability for any investment decisions based on the use of the software, any trading strategies, or any information provided in connection with the company. All right, hope you guys enjoyed that as much as I do. Mark Sebastian is somebody I had the privilege of meeting in person. I think it was back in November at the Traders Expo, or they did it in October.
Yeah. No, that was when.
So he's got a great history. He started trading in 2001. You're working for a company called Group 1 Trading, I believe?
Correct.
And you're a market maker.
Mm-hmm. Indeed.
And he had some interesting stories. I had no idea how that whole side of the business worked, so it was very enlightening to meet him. He's been doing Option Pit for how long now, Mark? Since you want to talk, I'm going to let you do my job.
We started in 2010 or 2011, something like that.
Yeah, I had 5 years.
2011.
Yeah. Okay, cool. And he's been doing that. He's been on CNBC. He's been in Fox, and now he can add to his resume the MetaStock webinar room. So I'm sure it's going to be.
This is going to be at the top of my resume. Are you kidding me? It's going to Mark Sebastian present for MetaStock, and then here's the balance of his credentials.
All right, here you go. So I just put the screen control over to you, Mark.
Mm-hmm.
What else do you want to tell us about yourself while you're getting that loaded?
Don't worry. I'll give everybody plenty of time to hear about my favorite subject, which is me.
All right, very good. I'm going to let you go then. I'm going to let you just kind of take over from here.
Well, thanks, Jeff. Yeah, you guys are hearing this like grainy, nasally voice. To me, I'm hearing like a combination of Beethoven, Mozart, and Bach all in my head playing the one symphony they wrote together at once. That's how beautiful my voice sounds to me. Maybe not anybody else, but so today we're going to talk about using volatility to prove a directional trading. I'm going to show you some screens that I look at on Icon and a few other things. Well, thank you. That is me talking to my girl Liz Clayman. I've done a lot of television because I like the sound of my own voice, but really I'm a trader first. I was a floor trader for about a decade, and then after that I started doing education and consulting work. On the consulting side, we work with hedge funds, money managers, asset managers, and we help them implement option strategies. Then on the retail front, we work with individual traders, helping them approach trading the way we do, the way as a professional does. And then when I'm not running Option Pit, I also manage a hedge fund called Carmen Line Capital, that's a small private group. So that's really what we're about. We've worked with individuals that have, $1,500 to their name. We've worked with individuals with groups that manage $15 billion. So that's kind of the gambit of who we work with, and we really treat them the same way because we want you to understand professional trading and trading approaches. So we're not a gimmicky approach, but we are definitely gonna kick you in the rear. So that's really what I'm about and what we're about. So today we're going to talk about how volatility can act like a headwind or a tailwind to successful trading. And I'm going to go through basic buy-sell decisions to profit from directional trading. I'm going to discover how strike selection can make the difference between a good trade and a bad trade. And I'm going to go through a combination of buy and sell strike decisions. If we have time, I will try and pull something in for VIX. We may not have time, unfortunately. So, options and stock. You know, a lot of people, I think, tangentially get options, or they kind of think they know what options are, but maybe they don't really understand it. Options are a derivative of stock. And so the key to understanding how an option price is going to move is to understand how it is correlated to its underlying. Correlation means how one instrument moves with another. All right. So how, you know, when Jeff and I hang out, with the amount of hours we spend hanging out is directly correlated to the amount of laughter that we have over a 3-hour period. You know, so that's a very simplistic one. You know, but really with stocks, it's how well the option price correlates to another. You know, a pairs trade is a correlation trade. So a correlation of one means that two instruments will move perfectly with one another. All right. Very few things actually have a correlation of one. All right. The only correlation I can think of is the amount of hugs I will get from my wife in a 24-hour period relative to the amount of Chanel purses I may or may not buy her. That's the simplest one. But, you know, people think of like Coke and Pepsi. Do they correlate? Does Yum Brands, which is KFC and Taco Bell, correlate to McDonald's? Things like that. The most famous one used to be KLA Tenacor and Novellus, and I'm pretty sure neither of them exist anymore. They probably both got swallowed. But those two used to correlate at almost a 1 because they kind of did the same thing. Now, options will correlate somewhere between 1 and -1 to the underlying. The correlation of an option will never be more and will never be less. Now, there's a rare exception where it can kind of be like 1.01, but it's really, for our intents and purposes, 1 or -1. All right. So delta is the option trader term for correlation. All right, that's what we use for correlation. In math, it can also be called slope. I do a kind of a comedy podcast with and I work on a comedy podcast with a guy that I did improv with, and he was a biology major, doesn't know anything about finance. And when I explained to him that all I'm really doing is kind of trading slope, is he kind of got it. All right. So there are some pieces. The interesting thing about options is that over time, an option's correlation to the underlying changes. There are other things that can change that, right? Delta, which is that correlation, can change with the passage of time. It can change with change in the underlying price, change in strike prices, change in duration of the trade. There are a lot of things, but the one that we're going to really cover is volatility. And it's really important to understand that volatility can move delta. So delta we describe in kind of many ways, but as stated above, it's that correlation. So an option that has a positive delta of 0.6 will make 60 cents for every dollar the underlying rallies. It will lose 60 cents for every dollar the underlying falls. What makes delta so hard is that it can change. All right, delta can change with you. But the one that I think throws traders for a loop the most is volatility. All right, and so if you don't understand volatility, you won't understand delta, and you won't know how to trade options. And you will lose money trading options. So this is kind of how the delta of an option will move with the stock as it becomes in or out of the money. This is a very crude drawing with the passage of time and as the underlying rally. So if this is my strike price right here, and the green is my stock price, the blue kind of represents how the delta and how the underlying will correlate to the underlying stock. So this is a story I get all the time. Mark, market makers are cheaters. I bought all these calls right before earnings. The stock is way higher, but I am not making any money. Market makers are taking my money. And the answer is no. No one took your money. Your inputs changed. Right? The inputs of your trade changed. So the Greeks, of which delta is one of, are actually produced by a pricing model. All right. Now, one of the things to be aware of is that anytime we model things, we can get a lot of stuff wrong. Anytime. So there are all sorts of things that get modeled wrong. You know, most recently we had this NCAA tournament, and the modeling had that, you know, X team had the highest chance of winning. You know, all these models had Villanova with only a 44% chance of winning. At the half, they had Villanova with only a 26% chance of winning. But modeling, you know, which tries to predict things, can be wrong. And in this case, we all saw Chris Jenkins hit that shot, and we all saw Villanova win. So options are kind of like betting on sports. Your pricing model says your percentage chances of winning, but that doesn't mean that it's actually going to follow that. Right? They're modeled risk based on your inputs. Right? If you don't put in the right inputs, your outputs stink. Anybody ever heard the term garbage in, garbage out? Basically means if you put crap into a model, you're going to get crap out of it. And that's really what that means, and options are just the same. So I think the key is to look at your delta. And actually, this happened to a trader friend of mine today. A key is to look at delta and be aware that it can move on you. And this happened to a trader friend of mine. So a trader friend of mine thought, he and I were talking yesterday, and he thought the SPOOs, which is the S&P 500 futures, were going to drop today. So he asked me for, you know, a few ideas. And my initial idea was a put spread. And he said, no, I don't want to pay that much. So then I gave him another idea. And what he told me was, you know, my spread that I put on, my complex spread, had a delta of 10. And the SPOOs are down 30. I should be up $1,500 a spread. Instead, I'm only up $1,000 a spread. And I said, well, volatility moved on you. And he got really upset. And the sad part is that I know he knows about it. So the answer is market makers aren't cheating. It's that volatility changed. All right. The underlying change, your delta changed on you. So the key to understanding this stuff is that delta can change in its model. And so you can't just say that option is a buy, that option is a sell, because the volatility might be off. All right, so when deciding a directional trade with options, and whether you need to decide whether an option should be bought or sold, in the money or at the money or out of the money. It all depends on one thing, and that is the implied volatility. So now, what is implied volatility? All right, and this is the key. What makes trading volatility different than trading a stock is that over the long term, we know where implied volatility of a stock or index is going to go. We don't know where the implied volatility of a stock, or where the stock price of a stock is going to go. So there's this reversion, mean reversion within options that and implied volatility that really changes the landscape of trading. So here is Apple. It's this little fruit company headquartered in Palo Alto. Might have heard of them. And this is a candlestick chart. The purple line is this is a simple moving average, so I'm not even doing anything crazy. Simple moving average, purple line is the 50-day moving average. And the green line is the 200-day moving average. Does that look like it has an average or a mean in any way, shape, or form? The answer is it does not. Now what I want to do is pull up a volatility index. So has everyone here heard of the VIX? Do we know what the VIX is? So the VIX is a running gauge of implied volatility in S&P 500 options. Now, how many of you knew that there are VIX indexes for individual equities and for about 40 to 50 other names? So let me show you something. This is VXAPL. Now, VXAPL is the VIX of Apple. Now, you tell me, does that 200-day moving average seem to be mean reverting? And this is like a 2-year chart. And what about that 50-day moving average? It does. That's because there is mean reversion. There's mean reversion in Apple options. So stock and option indexes, there are levels where we know that prices are likely to move around and are likely to revert back. All right, we're going to talk about this some more, but take a look at this. Can you tell me over and over again over this 2-year period when Apple options probably should have been bought and when Apple options were probably juicy? Yeah, I mean, take a look. I could literally say, okay, yeah, I want to buy 24% volatility and I want to sell 36% volatility. Now, it's not that simple because there is other parts of volatility involved. But there is some clear levels where option premiums are too cheap to sell. So the key is a stock price can go anywhere and stay there. And while volatility can go anywhere, it can't stay there. It will revert back to its mean over time. So understanding this can help with those buy and sell decisions. So let's talk about some basic buy and sell decisions. So in general, when implied volatility, when that VXAPL is low in the near term, and especially low in the long term, all right, it is time to start buying options instead of selling, especially if you are not delta hedging like I do. All right. So when IV is high or normal, it typically makes more sense to sell options or call and put spreads. In this case, you're probably going to want to do spreads if you're a retail trader. But vol can be low or high for a while. Yes, but even when it's low, it has its levels. All right. One of the things we kind of discussed, but I'm not going to get into too much detail, is we look at the overall market volatility structure, and then trade individual equity and ETF and index vols within those different volatility zones. Zone 1 being low vol, Zone 2 being medium low, Zone 3 being medium high, and Zone 4 being high. So when we're in Zone 1, volatility has levels. When we're in Zone 2, volatility has levels. And that is how this stuff moves. It's that simple. So now the key is to just start understanding. So now let's start with getting long. So let's say you want to set up a long position in an underlying. When one wants to go long, you can sell puts or buy calls. Each trade acts very differently despite having a long exposure. So a short put is long delta and short vega. Now what vega means is that it's short exposure to volatility. You want volatility to go down. Thus, a trader is actually hoping that not only does the stock move higher, but that the movement slows down. All right, so what makes volatility in an option stop or drop? It's because movements drops, or HV. You know, one thing I can kind of pull up on icon. Let me just get this. Where's my? There's my. That sucker is. Where is my vol chart? You know, this is, that's not the one I was looking for. I mean, no, this is implied volatility. I don't have it on this one. I have to pull up. That is a cool space to look at. Let me go to this one. This one, this view does. Oops, wrong one.
You done?
No, go. And oh, this is the vol surface. If I can find my vol chart here, I don't know what I did with it, unfortunately. Here we go. All right, found it. All right, so here's my volatility chart in XLP, but I can switch the instrument. I'll do Apple. And I can look at not just this. What I like about what's here is this is All right, I can kind of look at 1 month vol, and I can look at movement. So at XLP, I've got this orange line. So we'll just use XLP. I don't know why my computer is being a little wonky. Got this orange line. Now this is movement of XLP. And then the yellow line is XLP implied volatility. And then if I look at them together, I can see why implied volatility might be low or high. But both revert back from whence they came. So what makes IV drop? IV drops because movement drops. So a short put is actually a play on movement stopping. Yeah. So an event passing, but sometimes movement just stops or slows down or worrying. I mean, up until today, the market had stopped. Movement stopped. Yeah. Sorry, what is HV? HV is 23 is historical volatility. So it's what movement has done in the past. It sometimes can be called realized volatility. So when movement starts to sink, then implied vols start to sink. So the way I want you to think about it, when you decide to sell a put, anybody like selling cash secured puts? Or credit spreads? So when you sell a put credit spread or a cash secured put, you are actually betting that the underlying isn't going to go down. You're not betting on a rally. You're betting on the end of a sell-off. So now here's a great example. All right, this is USO, this top chart, and the bottom chart is OVX. And I'll tell you, we set up, look at the vol in here. Look at OVX. OVX is the VIX of option of implied volatility on USO. I mean, look at where that got. When OVX vol got up here, despite the movement in USO. All right, let me see if I can pull up that USO chart. What am I doing wrong here? Oh, duh. There we go. I think we're looking at this one. So there you go, United States Oil Fund. I'm not sure why it's not. There we go. And if I want to see charts, when I'm messing with this stuff, you know, I love pulling on in the different pieces here. And I'm not sure. I'm not sure why this does not want to let me put in something new right now. I mean, there's crude. Oh, here's crude. This is good enough. So crude basically is USO. So you can see the movement super high in crude. How do you find HV? So you're going to have to go to the SIBO website, or you can search through Icon, or MetaStock. They can get all that stuff to you. It's pretty great. So then here's that calculated historical volatility, but then look at volatility. I mean, it just gets insane. I'm going, okay, movement's going to drop. And you know, look at, if I pull up 10, so here's my user-defined 10-day volatility. And you can see how it never really gets there. So what I did was, you know, we looked and said, okay, this is a here's an area where I want to sell puts. And right now, even as I look, I'm looking at this and going, okay, we've now left zone 4, which is this area, and we're into zone 3. And even in zone 3, I think vol's going to drop. I am a put seller here in oil, USO, you name it. I will sell puts. Right. So this is one where I'm kind of all over put selling. So now, and again, OVX, one that you can follow along with. So a long call is long delta and long vega. All right. The trader is hoping that the underlying goes up and vol goes up. So what makes this happen? The answer is an increase in movement or an increase in expected movement. You're actually looking for things to go up. So here's Alta. Take a look at Alta vol in March. Take a look here. This is implied volatility. Oh, this is XLP. I'm sorry, not Alta. I actually want this to be XLP. So, and I put these together last night. So that's part of the reason why, you know, maybe there's I like to use really up-to-date numbers. So take a look at implied volatility of XLP. And then take a look at the run it's had. So this is, I think XLP is moving higher from here. And I think the vol's underpriced. I think the premium's underpriced. I want to own options. So when I look at XLP, all right. There you go. So when I look at XLP, I see all sorts of things I want to own. I mean, I can buy a volatility. Get this to here. I mean, I can buy volatilities that are just inexpensive relative to where they've been over the last couple of years. And this is going back to, I mean, if I can take this back really far in Icon. So I'll take this back like 3 years. And so we're all the way back to 2013 when volatilities were in the toilet. I mean, I'll take them back to, like, we'll go back 3 years. We'll go back to April 5th of 2013. And we're at levels where even in some of the lowest volatility times, I wanted to own premium. So when I look at what's going on here, I say this is a product that I want to own calls in because I think it's going up. All right, so now let's talk about getting short. Same thing, all right? Like going long, when one wants to make buy-sell option decision, one must take the IB into account. When an IB is high and one thinks the stock is going to go down, sell call spreads. When IB is low and one thinks the stock's going to fall, buy puts. So here's EWZ, all right? And I think EWZ is going a lot lower, but take a look at this volatility. You think I want to own EWZ options, or do you think I want to short call spreads? Just looking at things the simplest manner possible. I want to sell call spreads. It's that simple. All right, now here's one where maybe I'd want to buy a put. This is from last night. I printed this up. And I said, boy, I think I want to buy puts in the SPX. All right. You know, the point is, so the question is, Mark, even if vol is cheap, how do you gauge market direction? Well, the nice thing is if you buy cheap vol or sell expensive vol, you can be wrong and not get beat bad or maybe win, especially on selling. Now, picking a direction itself, that is an entirely different webinar. Why not sell call spreads and use the proceeds? Because the puts are so cheap. And if I'm wrong, I will get absolutely obliterated on my call spreads because the vol is so cheap. Whereas if I'm right, I will make an absolute killing on those puts. There is nothing wrong with owning premium, especially when you can get it dirt cheap. How do you think when I was looking at the market yesterday and I said, boy, look at VIX and look at where S&P is. I think puts might work. You think the call spreads made much of a difference? No. Here's what I would say, though. One thing that we do that I think is different is what we might do. Yes, we are in the future. If they can ever. The question is, are you developing an add-on program with MetaStock? I don't know, Jeff. Maybe someday. But that's the plan. So my response to the person who said, why not sell calls? Why don't I sell calls in a product where vol is high, like EWZ, and then use those proceeds to buy puts where vol is low, like in SPX? Why wouldn't I do something like that instead? Did I just blow your mind? And that's kind of what we do at that's what, well, it's a vol pair trade more than a stock pair trade because you think both are going to go down. I'll tell you, it's much easier to trade pairs of volatility than it is to trade pairs of stocks. Especially in indexes that correlate. All right, now, the next step is to select the right strike. Indeed. All right, now, strike selection is just as important as buying and selling decisions. And so the key is, what's the next volatility move going to be? So when one believes that IV is going to go up or be stable, it makes sense to go to buy softer deltas or sell harder deltas. And when one believes IV is going to go stable or go down, it makes sense to buy hard deltas or sell soft deltas. And I'll explain the two. A hard delta is a delta that is relatively resistant to changes in volatility. Hard deltas are in the money. All right. Hard deltas are deltas that are in the money or at the money. And then a soft delta is relatively dependent on a change in volatility, right? And those are your out of the money options. So when you're swinging for the fence buying out of the money calls, you're really dependent on volatility. So the strike selection is key. So when would you want to own a hard delta or be short a soft delta? And that's when one isn't sure of IV's future movement, or when IV is high, or if one isn't sure of the severity of the expected move. So here's Goldman. All right, and there's been some real times where vol's been high, and low. You can kind of see some areas here. So let's look at this. All right. So you've got, in Goldman, I can buy one of the December 110 calls, or I can buy like 7 or 8 of the December 125 calls. All right. Option 2, well, let's kind of see what they do. You can see both go up in value, but what was actually the better trade? Well, let's do some math. So 11.15, Goldman Sachs is trading 115.44. I buy one DC 110 call for 760 that has a 70 delta. You can see the delta right there, 70 delta. I buy 8 Goldman Sachs DC 125 calls for 96 cents. I'm buying 130 deltas. I'm spending $768. You can see that's 17 times 8. So let's see where the Goldman moves $5 over the next 8 days. So if I bought my one call is worth $10.65, I make a profit of $3.05. That's $305 for a one lot call. Now my 8 125 calls that I bought, I made $184. So even though I bought more delta and I spent more money, I made about half of what I was expecting to. I made about half of my in the money option. Interesting. And the key was I want it the vol was high. When vol is high, I don't want to own out of the money options. I want to own in the money or be short. My other option would have been to short an option here. I could have sold I could have sold the 115 puts, or done the 115 100 put spread. No, as soft delta, and now soft deltas are more sensitive to IV changes. So when vol is super, super low, you buy out of the money options or sell in the money options. And that is why you do that. So here's IBM. In IBM, and this is VXIBM, you'll notice that back here was VXGS. So you can see IBM, even after tanking, there's a huge gap. So this is one this is a trade we actually did. It's one of my favorites. And then look kind of what happens here. So they tank volatility to like the nth degree. It was nuts. Let's see what happened here. So all right, they tank volatility. It might be the different one. And I've got some opportunities where I can buy calls if I think the stock's going higher. I would not do IBM at this point because I think IBM is garbage. But if you look at where some of these traded, when they just tanked vol, I mean, look, if you didn't buy options here and here and here and here, you made a mistake. Let's take a look. 11:21, IBM's trading. I can buy the 185 calls, or I can buy the 195 calls. So I can buy one call for 680, or I can buy like 5 calls for 122. So you can see they both make money a couple days later. So on the 21st, IBM closes 190.29, and on the 23rd, it closes 193.48. My 185 call, I paid 680, and I paid 75. I bought 75 deltas. All right, or I buy 5 of the 195 calls for 122, and I pay 145. So I spent 680, I bought 145 deltas, or I can spend 610 bucks. Well, take a look at how my two trades did. Now my first trade does great. I made 250 bucks. But look how well I spent fewer dollars. I spent $70 few and I made more than double. That's why you look at the vol. Soft deltas outperform. All right, so now I'm going to give you a couple of combos that I look at. All right, and I track, and we are going to embed some of these into scans eventually with the MetaStock boys. So a simple way. Now you've got these great IVs you can track. All right, so find your stocks that you like. And when the stock hits a 52-week high IV, and that VIX index or the implied volatility simultaneously hits a 52-week low, wait 1 day and then buy a call out of the money. It will pay. It will pay. This is one of my favorite trades. And this is VXGS and Goldman. We had a couple of ones where the vol just got disgustingly cheap as it was hitting. Here's the one I know that we traded. We traded this guy, bought here. Actually here. And we traded this guy, which was later, and got long in here. I mean, it's like clockwork. How often do you see this? I mean, it depends. When vol's low, it can happen. Now, here's one that I actually think works better. When an IV or a VIX methodology hits a 52-week low, at the same time a stock is hitting a 52-week low, buy the second put out of the money. Sinking IVs and sinking stock typically mean the stock's going lower. So here's gold. And this is one we traded. We bought puts right here. And actually, I'm watching gold vol to see if it gets back in here. And if this gets back up to like 122. Because if that happens, we may be looking for an opportunity to buy calls in gold. And yeah, like I said, I'm going to talk too much to get to the big stuff. But I can go over that some other time. Hopefully they'll have me on back to talk VIX. Summary, volatility reverts. Implied volatility helps form positions. There are different types of delta for different positions. And make sure you're aware of the position sensitivity to changes in IV, the hard versus the soft delta. So now, have I got a deal for you? All right. And this is a special offer. All right. This was just the beginning. I want you to understand how to trade like a professional and learn from the masters with our Option Pit Live special. All right. This is for new members. You can access our special members area, follow our strategy letter. Our strategy letter, we follow trades from start to finish and adjust them that you get with our Option Pit Live service. We have a chat room that's open all day. We do a daily pit report where Andrew and myself, Andrew's my number 2, go on and we talk for a good half hour to an hour about what we're seeing in the market, what trades we like, and then we actually cover all of the trades in the strategy letter. And you get access once a month. We do our special Saturday classes. Last month we did calendars and diagonals. This month we're doing long-term strategies. And you get email and phone support. Now it's normally $125 a month. Great deal. We're going to do $17 for 1 month and then $97 a month after that. And you can see here's the link right here. I can throw it in the chat room for anybody that wants it. And so $17, and you are welcome to cancel at any time. And then just $97, and you're going to get that Saturday class that we're doing on Saturday, May 7th, I believe. So, any questions? You see these things, these trades pop up across all sorts of things. You can email me, mark@optionspeak.com, for the slides.
Rick, to answer your question, yes, we recorded today. So I'm sure you're going to want to watch it again, and we will send out a recording to you for as long as you registered, which you had to get in here. So yes, you'll get a recording of today's event.
Yeah, we absolutely look at vol analytics for earnings stuff. In fact, I believe the last time I was here, I did, as part of our multi-step presentation, I did some things on earnings. Will I be using MetaStock in my classes? MetaStock is one of the tools that we do use. I like the product a lot. Some of the things, the 3D vol surface stuff that MetaStock puts together, you just can't find with any other trading platform to kind of figure out how hot volatility is at certain levels. What is my, I generally don't trade a lot of earnings. But if I do, I'm almost always doing I'm usually doing something with a broken wing butterfly. Or a 1x3x2. Typically a complex trade. And by the way, I went to Villanova. That's why I used them as a, how do I find vol history and icon? That is where, under the charting, You go through the volatility chart, and that's where you can look at this stuff. And then if you pull up equity on your instrument, you've got historical volatilities, implied volatilities, or I can even do the spread, which is awesome. Okay, I'm great. What do I think about? I think Thinkorswim is garbage. I'll be honest. Don't say sorry, but I don't think the product's very good. It used to be good, but I think everybody in the world is caught up, and they're overpriced. Mark, are the Cubs any good? Bullish or bearish? I'm very bullish the Cubs.
Mark, is that an emotional or an analytical assessment?
I mean, if you look at what the Cubs did last year and who they added, analytically, every single analytic kind of puts them pretty high up there. So, and Villanova had a very high KenPom score. So a lot of the interesting thing is a lot of the quote unquote analysts did not have them going very far, but all of the modeling had them absolutely killing it this year. It was really interesting.
All right, show the web address again, just so that we can kind of show everybody where to go.
Yeah, here. I dropped it in the little chat area. Let me. 132 or skip strike, both. I don't call them skip strikes. We always called them broken wings, but either is fine. They're two very different trades. A broken wing and a 132 are just two separate trades. They're two different ways of approaching butterfly trading. And yeah, did you see the demand there, Jeff, for my little scanner that I want to do?
Yeah. And we do want to do just to kind of give you guys some ideas, we do want to do a scanner with, to look for this kind of stuff. The stuff that we offer for, with our MetaStock Zenith data feed is tremendous. I mean, Reuters spent like $1 billion designing it out, and you can go in and see all of these at the money, implied volatilities, all that option data. It's a great product, and the thing is we actually are rebuilding our formula language to take advantage of more of this data that's available in Zenith, and pump it straight in so that we can handle scans like this. So it's definitely our end game.
The stuff that you can get here on this stuff is just great. I love it.
And if you want to get a trial of it, just go to metastock.com/option-pit. If you don't have Zenith, if maybe you're an end-of-day customer, or if you're just not familiar with the product yet and you just want to try it, just go to metastock.com/option-pit. I'll paste that in the link. We'll let you try it for free for 30 days. We'll give you access to a whole training archive. Zenith's huge. I mean, it basically does everything from all this option volatility stuff, all of your broad market analytics. It's great about that. Your news releases. I mean, geez, you can even go in and see how a stock is trending on Twitter if you want to.
I think if you're an option, Jeff, their option stuff is better than what Bloomberg has. I think that's kind of how I would put it.
There you go. I'll let you share that. So here's the link to that trial.
Let's say as good. And does anybody here know how much a Bloomberg is a month?
I just had it happen the very first time I sold it, and then last week. It's happened twice now. The first had somebody that said, I just canceled my Bloomberg. I'm saving $1,850 a month. Yep.
Yeah, especially if you're an option trader, you don't need Bloomberg. You can get everything you need off of what I use at Icon. Yeah, it's typically, depending on how many you have, it's 2,200 down to 1,800, depending on how many terminals you have.
Oh, the link doesn't work. I just looked at it. Let me make sure I got the right one. You know what? It probably doesn't have the hyphen in it. Thank you for noticing that. And it doesn't. So here's the appropriate link. Let me type it in. /option. Okay, there you go. Thanks for noticing that, Kenneth. I appreciate that.
Me too.
All right.
All right, Jeff.
If you guys need to get it, thank you, Mark. Really appreciate what the class.
Yeah. Hopefully you guys learned something. I always want to bring something special that you guys can pull.
Well, do you have any final thoughts?
I think today, we're going to gap down tomorrow and then rally through the afternoon and then make a run at 2100.
Interesting.
I will be looking at short puts on the open, not on the open, but I will be looking at short puts tomorrow. Doesn't mean that I'm right, but that's the way I view things. And we had a huge volatility short squeeze today. So that was one of the things that I think drove the sell-off. If you follow VIX futures, they just got absolutely, it was crazy. All right, well, I'll let everybody go. But,
all right, thanks, Mark. Thanks, everybody, for coming.
Thanks again, Jeff.
Great
Thanks,
class.
everybody, from MetaStock, and thank you. Have a good one.